Hi everyone, my name is Robin Speziale and I'm the national best-selling author of a book called Market Masters. Okay, so today in this video, I want to be talking about the top 10 mistakes that investors make in the stock market. Now, I'm going to be honest and truthful. I've made all of these mistakes, okay? I've been investing for over 12 years now, since I was 18, and I'm a better investor now. I'm a successful investor because I've made the mistakes, I've corrected them, I don't repeat them. And so now I can actually increase my odds of profiting in the market. I can increase my returns, and I can do this over time by avoiding what I believe these are the top 10 mistakes I see too many people make, especially people who first start in the market. So I'll be going from 1 to 10 top 10 mistakes. They're not in rank order. I think they have equal importance. So mistake number 1 that investors make in the stock market, they buy what they don't know. So they'll buy let's say a semiconductor chip stock, and they'll have no idea how the semiconductor is used, why the business exists, who the customers are, let alone know the financial statement, whether they're even generating a profit. So Lynch was one, Peter Lynch, to say that if you can't explain a company and what they do to a child, if you can't draw it with a crayon, don't buy the stock. And Buffett has said that, if any company, any industry falls outside of your circle of competence, just don't buy the stock. The number 2 mistake that investors make is either they hold too few or too many stocks. So the problem with holding too few stocks, like I know some people who hold like 5 stocks in their portfolio, is that you can get whipsawed by the market. Okay, so you've opened yourself up. And on the other side, if you own too many stocks, too many companies, it's just impossible to track all these companies. And you've already maxed out the power of diversification at that point, and here you're diversificating, is what Buffett has said. So number 3 is dollar cost averaging. So this is a big mistake that so many investors make. It's when they buy a stock in company A at $10 per share, it goes down to 8, and the investor says, okay, now it's cheaper, I'll buy some more shares at $8 per share. And then it goes from 8 to 7, they buy more, 7 to 6, 6 to 5. This doesn't always happen, but one should view a stock like they would view a business. And before you start buying more at cheaper prices, you should look at the business and see, okay, first of all, what's happening? Is this a short-term issue the business is going through? Is this a systemic issue? Are there new competitors that have made it so this company has just has fallen from grace? It'll never be able to command the same market share it has ever again. And so you really have to do this analysis before you start buying into it again. And so what I do, and I'll segue into point number 4, is that you should be adding more money to the stocks that are going up. The businesses that continue to grow, the businesses that are successful, in this competitive environment, and in 10 years when you have new competitors in their space. So number 4 is a lot of investors, they sell their winners way too early. And you have to ask yourself, why are you investing in this company? Are you a short-term trader, or are you going to be a long-term investor? And I find, at least, that for building wealth, and to do it in a smart way where you're not paying too much in taxes or commission, it's to buy a growth company. Buy it as soon as you find it, and when you find that gem, when you find that home run, just hit the ball, right? A lot of people struggle with that, and a lot of people think that when a stock is run up, they'll call it overvalued and just sell the stock. But some investors' biggest regrets are errors of omission, meaning that they saw like a growth stock come on the radar and it just looked like such a great thing, but they didn't pull the trigger, they didn't buy it. But then the other biggest regret is buying it and then selling a winner that went on to post, 1,000, 2,000, 3,000, 4,000, 10,000% gains after you sell it. So mistake number 5 that investors make is changing strategies too often. And what that means is, an investor going from being like a value investor to a growth investor to value to growth, really not knowing why they're buying the stocks in their portfolio. The stocks that you buy, the companies you invest in, the reasons that you buy these companies have to be, you come to these decisions based on your portfolio strategy. And so before you even consider investing in stocks, what is your portfolio strategy? Because that's going to determine what stocks you put into your portfolio. And once you come up with the strategy, it'll be easier to stick with the companies that you buy, and you won't be whipsawed through the markets. Mistake number 6 that I see some investors make, not many, is using too much leverage. So if you open up a margin account and you're always tapping your margin, you're tapping your credit cards, you're tapping your line of credit, and what some people do is that they start using debt to buy stocks at market peaks, whereas the best way to leverage debt is at a market bottom. And debt can amplify your returns, but it can also amplify your losses as well, and it's harder to get out of that hole. And one of the worst things is getting a margin call. So the mistake that investors make, number 7 here, is trying to time the market. So I've talked to so many people, it's just nuts to me now, that say, hey Robin, like I'm on the sidelines, I think that markets are expensive, and I think we're due for a crash. And I heard that in like 2011, 2012, 2013, sometimes the same person still saying it since then. And they've sat on the sidelines through the entire bull market. I'm referring to the one in the United States. If you look at the S&P 500 since 2009, people calling a second crash for whatever reason. A lot of people saying that countries being over-levered with debt. But it's never too smart being over skittish, and it's never too smart either being overly bullish. But what I remind people is that you're not buying the market, right? Like you're buying individual stocks. So, even if the market is overvalued, perhaps the 10, 15, 20 companies you have in your portfolio, they're growing so rapidly, even if there is a big shock, a recession, perhaps they're selling soda pop or juice or water. Are they really going to take that big of a hit, right, through recession or market correction? There's no point sitting on the sidelines and not having your money work for you. So mistake number 8 that investors make is, seeking stock tips, seeking advice from, friends, colleagues, family. I've always believed, do your own research, bottom up. That's how you start. Warren Buffett, what he said in an interview is that Warren Buffett, he went through every single annual report. When he was a kid, he would buy Value Line, he would buy Moody's reports, he would just buy everything he could get his hands on before the internet. But now that we have the internet, you can easily filter companies that you want based on metrics. But I still recommend everybody here go and look up every TSX Venture, and every S&P 500 and Dow Jones stock. Look up every annual report. It'll hone your ability to identify good companies, where you'll get to a point where they'll just jump out at you. So number 9, this is a big mistake that I think most people make in their lives, not just in the stock market, but the mistake people make is being too greedy, being too proud, thinking that you're too smart, where you think that you're a genius because of this bull market, where you really have to consider, that all stocks are going up in a bull market, right? Like you're really not that smart. I did my research on marijuana stocks in 2015, and before all this euphoria around marijuana stocks, like 2017, 2018, and I bought into Tweed, which became Canopy Growth. But I still don't consider myself that smart, right? Like I'm not going to get greedy and buy more on margin now. I see it could be topping. I'll still hold a smaller position in Canopy Growth, but I have to I have to kind of harness myself. Like if I think that I can make more of these wonderful bets, then I might get sloppy. So I have to bring myself back to earth here all the time. Keep on doing my research and due diligence to find the next couple of good stocks, and maybe some will turn out to be 35, 40 baggers like Canopy Growth, but I'm not counting on it. So number 10, the last mistake I have here that investors make in the stock market is some investors just read too much. We hear people like Warren Buffett and mutual fund managers, hedge fund managers reading, like all day. But these are people who, read what they want to read, and they stay within their sphere, their circle of competence. Once you read too much, if you're reading about tech and biotech, and you're reading about the lowering of the corporate taxes in Europe and the effect that will have on companies there, or like a lowered Canadian dollar and the effect that it'll have on certain companies in Canada. If you're reading too much in all these different macro trends that don't really matter to a company like National Beverage, or a company like Match Group, which sells subscription services to daters online, like on Plenty of Fish, OkCupid, Tinder. It doesn't really matter what the heck's going on. People can get boggled down in all this information, especially in the information age. I find that some people like Buffett and others, I'm always trying to refine my own information filtering process. Some people just get almost like ADD, right? They're just looking all over the place, or like a dog when he sees a chipmunk or a squirrel. They're just always looking at the next thing. Whereas to be a really good investor, you stay focused. You stay focused on the information that matters to your investment strategy and the info that matters to your companies in your portfolio. Okay, guys, so these are the top 10 mistakes that investors make in the stock market. And I've made all these mistakes very early on in my investing career as a do-it-yourself investor. From the time I was about 18 to 25, I've corrected these mistakes, and the returns have bettered over time, and I've become a more successful investor. So guys, if you have any more questions, go to robinspeziale.com, or hit me up with an email. Send one to r.speziale@gmail.com. Talk soon.